Hi, my name is Eric Balchunas. I am the Senior ETF Analyst for Bloomberg Intelligence. I manage a team of about 4 people. Hopefully, we're expanding very soon as well that cover ETFs, mutual funds. We even cover SMAs and closed-end funds, but largely ETFs and largely in the US. And so I want to go over with you today just some of the themes that we're thinking about, some of the topics we keep writing about, and some of our calls that we think are important for people to know. So with that, I'll get right into it. This is the Institutional ETF Outlook. And the first thing I want to go over really is ESG ETFs. There's been a lot of hype around this area, as you know, but we think they're going to face hurdles. While we think ESG as an additional way to analyze the stock, in complementary to fundamental metrics, is here to stay. We think that's definitely happening. But we think an ESG ETF as a product is just going to face some hurdles in the future in terms of asset growth, and we don't see it getting beyond 5% market share. And here's why. Here's a bunch of ESG ETFs, and here's the stocks they exclude. And you can see here, it's really a very subjective process, and we think that subjectivity is ultimately going to hurt it. Is Amazon ESG? Is Berkshire ESG? By all accounts, no. Is Apple? And then the weightings are different. I think it's very active, and to put this into the core of your portfolio is making an active decision and requires a lot more due diligence than it looks like you need to do. In addition, companies like Tesla, is Tesla ESG? If you ask 10 ESG analysts this question, you're probably going to get 5 who say yes and 5 who say no. Like that, it's not in every ESG ETF. It's in a lot of clean energy ETFs, but it doesn't make it into every single ESG. So they'll say Tesla is good on the E, okay on the S, and horrible on the G. And so that's sort of what you're looking at here. And with ESG, the company's either in the fund or it's out. You're going to throw babies out with bathwater, and you're going to keep bathwater with some of the babies, and you're going to have to live with that. And again, it's just so subjective, and one of those moves could really change your performance. And we just think this is going to make it difficult long-term for the assets. There's also been a ton of whistleblowers who have come out, both from BlackRock and DWS, basically saying, hey, there's a lot of marketing going on in this. And that's giving it some baggage. I think it's making it a little more controversial than just, oh, hey, let's save the world by investing in these funds. And then Gary Gensler of the SEC is looking into disclosure and marketing of ESG. So that's something that could affect their growth as well. There are some unique ESG ETFs. I won't go through all of them here, but engine number 1 is interesting. They do activism. So you hold the whole S&P, but you just basically have them try to get bigger institutional owners to vote in an ESG way. Just is interesting because it looks at more how corporations pay employees as opposed to climate issues. And then the fossil fuel we like, it's just the S&P minus some energy stocks. And I think that's a clean way to just basically, if you're not into energy, to do it. And there's some other ones over there that complement the core. That's the big thing. If you have a Vanguard fund in your core, it's very difficult for an ESG fund to displace a 3 basis point total market fund. However, something like clean energy or solar energy or uranium or the new one from ARC could complement that core. And so we're a little more bullish on those. Speaking of which, uranium, I just want to say this is a story that we've been tracking for a couple of years, and it's really interesting. We call it green investing for realists. We think that uranium is going to be a big deal because nuclear is going to have to be part of the solution. If people want to keep up their lifestyles and emerging markets want to use energy as much as we did as we became a rich nation, you're just going to have nuclear. That's what a lot of people are coming to. And you can see it in URA and URNM. Look at the flows and the volume. These things have really broken out and become legitimate ETFs with a lot of liquidity. Okay, ARC. ARC isn't going away. There's some thought that, it's the Janus 20, Kathy Wood's going to come and go. We don't think so. If you look at our flows of ARC, you can see it's in and out. And so since the 25% drawdown, ARC's having a tough year, there's really not been a lot of outflows net. There'll be a month or a week where it's not good, and then it'll bounce back. But largely, her investors are hanging tough. And the reason for this is because portfolios have changed. If the core of the portfolio is now dirt cheap beta, thus what people want is something to add on top of that. Call it hot sauce or shiny objects, whatever, we have a bunch of phrases for it. And so she's in that lane and ARC is in that lane. And if it's not your core, you're not going to panic as quickly. So we think the tolerance to withstand underperformance in ARC is there. It's the middle that's tough. These are funds that are sort of lower active share and charge over 40 basis points. A lot of the legacy mutual funds are there. The active non-transparent mutual ETFs are there. That is struggling. The middle is not a good place to be right now. And if you look at ARK, a lot of those companies on the right, they serve stuff in the middle. And you can see the outflows. ARK's taken in $35 billion in the past 2 years, whereas all other active equity mutual funds have lost $800 billion. It is really bad. So just the fact that ARK could succeed was a minor miracle, but now we kind of get it looking back. High active share active is probably going to be the new viable lane for active unless they're willing to go really cheap. A Bitcoin ETF will likely be approved in October. We think there's probably a 70-75% chance this is true. If you look, here's the funds that have filed. The reason we think a Bitcoin futures ETF is probably going to launch is because they're all going to be filed under the 1940 Act. Gary Gensler has said he likes this act. There's more protections under it. And since Bitcoin isn't a security, you have to file futures. You can't put a physically backed Bitcoin ETF under the 40 Act. And so all the physical ones are filed under the 33 Act, and we think they're going to be on ice for a while. We do think the futures will launch. And look, there was a ProFunds Bitcoin futures mutual fund that launched, and that was filed and launched 77 days after it was filed. Thus, if we look at that as a template, that puts the ProShares Bitcoin strategy on pace to be approved and launched in mid to late October. And so that's the lineup of funds you hopefully should expect to see approved. It's possible they delay them again, but given everything Gensler said and some of the things we've seen, we're pretty confident they'll approve these. And look, there's that mutual fund I talked about. There's a possible bad sign. The mutual fund was largely ignored. This tracks Bitcoin futures too. We don't know if it's because people don't want mutual funds. As I said earlier, they're not exactly the most desired wrapper right now. Or is it because it holds futures and people want the real thing? We'll see. The thing with this fund, though, it tracks pretty well. And there was some worry that holding futures would not track well because of the roll costs. So we think the roll cost might be 3 to 5% a year. It's not great, but it's not horrible. But we'll see. We think maybe 10 to 20% of the demand for a physically backed Bitcoin ETF will be there for the future. So it'll be a moderate hit, we think. We'll see. Mutual fund ETF conversions will grow. This is my final section here. When we think about the mutual fund, how are mutual funds going to adapt when all the money is going to ETFs? This year, ETFs are going to take in probably $800 billion, and mutual funds will lose a couple $100 billion, especially on the equity side. It's pretty bad. And we think they're going to convert to ETFs. This will be a more popular way to do it. There's already been about 12 conversions, including DFA, JP Morgan, Guinness Atkinson, worth about $50 billion. We think there's going to be $1 trillion worth of conversions in the next 10 years, and it will include hundreds of mutual funds. That said, that's still only 10% of all mutual funds. We think there's some that have deep 401k, penetration that you really can't convert. It's going to be too tough. But we're bullish on this because when you convert a mutual fund to an ETF, you come over into the ETF world with assets, a track record, a little more dignity, more weapons. And if you don't, and you clone yourself and launch a new ETF, I mean, you're kind of like putting a baby into the jungle. It's so brutal, and it's hard to compete with no assets. And again, if you're serving something that's benchmark aware, semi-expensive active, it's almost impossible to get flows. And what's interesting is there was a cannabis ETF, a mutual fund that recently converted, and that mutual fund outperformed all the cannabis ETFs, but nobody bought it. So here's a case where the mutual fund was like, look, I got to go to where the fish are biting. So it converted to an ETF just this week, actually. And it's smart. I mean, what else are they going to do? And so I think more mutual funds will come to this conclusion over the next 5 or 10 years. That said, there's multiple options for them to do this. They could launch a clone of their mutual fund. They could convert, or in 2 years, the Vanguard patent on making an ETF a share class of your mutual fund expires. They have a special patent on that, but that will open up. So in 2023, it's possible many mutual fund companies will simply launch an ETF share class of their existing fund, and therefore they can benefit in the tax efficiency and other things without having to convert or launch a new ETF. And so with that, those are some of the themes we're thinking about. If you want to reach out to us, that's how you can get me on email or follow me on Twitter at Eric Balchunas. And I thank you for your time today.